So, you've dabbled in crypto. You've seen the ups, you've seen the downs, and you've probably had that nagging thought in the back of your mind. What about taxes? It feels like this brand new world, right? But the old rules still apply, and let's be honest, getting it wrong can be a huge headache. So today, we're going to cut through the confusion and demystify the whole crypto and taxes situation. Let's do it. Okay, let's just start with the biggest question on everyone's mind. You bought some, maybe you sold some, maybe you even used it to buy something. Do you actually owe taxes on any of that? The short answer, yeah, almost certainly you do. But, and this is a big but, the long answer is why we're here. It is way, way more complicated than you might think. And all of that confusion, it really starts with a fundamental disagreement about what crypto even is. This right here, this slide gets right to the heart of the whole problem. You, me, most people, we think of crypto as digital money. But tax authorities, like the IRS in the US, they see it as digital property. And honestly, that is the single most important thing you need to understand. It means every time you get rid of it, it's treated like selling a stock or a house, not like spending a dollar bill. And that one little distinction is why this all gets so incredibly messy. So, to really get a grip on why it's treated as property, you first have to know that not all crypto is the same. It's not one big monolith. Regulators are starting to see them in, let's call them, three main flavors. Let's break them down. First up, you've got payment tokens. This is what pretty much everyone thinks of when they hear the word crypto. Bitcoin is the classic example. The entire goal here is simple, to work like digital cash. You can send it, you can receive it, you can hold on to it, all without needing a bank in the middle. Next up are security tokens. Now, these are a whole different beast. A security token is basically a digital, blockchain-based version of a traditional investment. It could be a piece of a company, a right to get some profits later on, or even a claim on a loan. The easiest way to wrap your head around it is to just think of it as a digital stock or a digital bond. And finally, we have utility tokens. Think of these less like an investment and more like a key or a ticket. They give you access to a specific product or a service on a platform. The analogy of a token for a digital arcade is perfect. You buy the tokens so you can play the game, not because you're betting that the token itself is going to be worth a fortune someday. Okay, so we've got these different types of tokens, but when it comes to taxes, what really, really matters is what you do with them. So let's look at the specific actions, the so-called taxable events that can actually land you with a tax bill. So because crypto is property, pretty much any time you dispose of it, it's a taxable event. Selling it for cash, like US dollars, that's the obvious one. But here's the big one, the one that trips up everyone, trading one crypto for another. So you swap some of your Bitcoin for Ethereum? In the eyes of the IRS, you just sold your Bitcoin, and you have to figure out if you made a profit or a loss on that sale right then and there. It's wild. And the same thing happens when you use crypto to buy a cup of coffee, or if you get paid for a gig in crypto. Every single one of these is a taxable event. And just when you thought that was complicated enough, it gets better. These rules aren't the same everywhere. Nope. How your crypto gets taxed depends completely on where on this planet you live, which creates, well, a very messy global picture. Just take a look at this. The differences are huge. In the US, like we said, it's property. So basically, everything you do is taxed. But then you hop over to Switzerland, and it's treated more like a foreign currency. That could mean that buying something with your crypto isn't a taxable event at all, which is a massive difference. And then you've got a place like Hong Kong, which might not tax your gains at all if it's a long-term investment. It's a total patchwork quilt of rules, so where you live matters a lot. All right, that was a lot to take in, I know. So after all of that, what are the absolute most important things you need to walk away with? Let's boil it all down to the final takeaway. First things first, just go ahead and assume your crypto activity is taxable. It's the safest bet. Second, and I can't say this enough, burn this into your brain. It's treated as property, not money. That is the key to everything. Third, be super, super careful with those crypto-to-crypto trades. They almost always trigger a tax bill. And finally, because of all this complexity, you have to keep detailed records. I mean, every single transaction, the date, the value in your local currency, what you did, it's absolutely essential. And this whole situation brings us to a much, much bigger question. Right now, we are trying to force these old tax laws that were made for things like stocks and real estate onto this brand new technology. But as digital assets become a totally normal mainstream thing, is that really going to work long term? Or are governments and tax authorities going to have to fundamentally rethink and redefine what money itself even means in this new digital age? That's the real question, isn't it? Thanks for tuning in.